Hello number-curious friends, welcome to the channel where we talk accounting and finance. Today we'll decode 4 liability buckets that show up on almost every balance sheet: trade payables, other liabilities, provisions and deferred income. We'll peek into real annual reports, Unilever, PepsiCo, NVIDIA and Microsoft, and anchor the ideas in our Apple Shop example. But first, as always, a quick refresher. Liabilities are promises you've already made. 4 common ones are: trade payables, amounts you owe suppliers for goods and services you've already received. Apple Shop owes the farmer for apples. Other liabilities, everything short-term that doesn't fit elsewhere. Payroll, taxes payable, leases and similar. Provisions, estimates for likely outflows when the amount or timing is not perfectly known yet, like legal claims or warranty costs. Deferred revenue, also called deferred income, unearned revenue or contract liabilities. Customers paid you first, you will earn it later as you deliver goods or services. Rule of thumb: payables and other liabilities are usually known, provisions are estimate-based, deferred income flips the usual order, cash comes in before revenue. Now annual reports. Let's start with Unilever. On page 140 we see in current liabilities as of December 2024 trade payables and other current liabilities of 16.7 billion euros. Which almost didn't change when compared to December 2023. In addition, here we see 0.7 billion of tax liabilities and 0.8 billion of provisions. And for details, we have notes 14 and 19. Let's check them out. Note 14 starts with the description of accounting policies for liabilities and their measurement. As typical for IFRS, they are recognized at fair value. And the note says that the fair values of trade payables and other liabilities are not considered to be significantly different from their carrying values. That means that the amounts are shown at nominal values and not discounted. Here we also have the split of payables. Current trade payables are about 10.3 billion and accruals about 5.1 billion. Plus taxes and other items bring current trade payables and other liabilities to 16.7 billion euros. The note also states that the trade payables include customer discounts of 2.2 billion, and that others include IT, consulting services, payroll-related expenses and refundable deposits. Unilever explains that some suppliers factor their receivables. As of year-end, 1.9 billion of invoices had been paid to suppliers by finance providers, but payment terms for Unilever are unchanged, and this remain classified as trade payables. Useful transparency for liquidity analysis. Now note 19 for provisions. It also starts with definition and recognition rules. Everything exactly as we discussed in our lesson. Past event can be reliably estimated, outflow is probable. Here we have a split into current and non-current parts. Current are 0.8 billion, total including non-current is 1.4 billion. And for the total, there is a roll forward, a very useful piece of information. Here we see that the increase in provision mainly came from restructuring provisions, plus 460 million. Below we read that these primarily include people costs such as redundancy costs and the cost of compensation for terminated agreements, for example distribution or selling agreements. Interesting fact, Note 20 also discloses Brazilian indirect tax contingent liabilities, 4.3 billion of known maximum exposure, which are contingent and that's why not included as provision on the balance sheet. It's a great example of IFRS judgment. Probable outflows get a provision. Possible but not probable outflows are contingent liabilities disclosed in the notes. Here, Unilever believes that the likelihood that Brazilian tax authorities will ultimately prevail is low. Before we move on, if you find our lessons useful, please take a moment to hit a like button, subscribe to our channel or leave a comment. And thank you for being with the channel, this is very important for me. Over to PepsiCo. On the face of the balance sheet, accounts payable and other current liabilities total $24.5 billion for 2024. In addition, there are 9.1 billion of other liabilities. PepsiCo gives a handy breakdown in Note 15. Accounts payable 11 billion, accrued marketplace spending 3.5 billion, accrued compensation and benefits 2.3 billion, dividends payable 1.9 billion, current lease liabilities 0.6 billion, and other current liabilities 5.2 billion. Other liabilities mainly include taxes, for example income taxes of 2.3 billion, accrued interest of 0.5 billion, pensions, lease liabilities 2.8 billion. This is your classic other liabilities mix. PepsiCo also discloses a supplier finance program with 1.5 billion of outstanding confirmed obligations as at year-end. These remain in accounts payable and other current liabilities, but the disclosure helps assess working capital quality. NVIDIA and Microsoft are great examples of deferred revenue in tech. Let's start with NVIDIA. The balance sheet shows strong growth in accrued and other current liabilities, and the note on page 70 breaks it down. The current liability mix includes customer program accruals of 4.9 billion, excess inventory purchase obligations 2.1 billion, product warranty and returns 1.4 billion, taxes 0.9 billion, payroll 0.8 billion, and so on, totaling 11.7 billion. That's also a textbook example. One key line is deferred revenue of 0.8 billion in current liabilities and 1 billion in non-current. Together that's 1.8 billion of deferred revenue at year-end. What does it mean? Customers have paid for support, software, cloud services or license arrangements that NVIDIA will deliver over time. NVIDIA even provides a roll forward. Beginning deferred revenue 1.3 billion, additions 5.1 billion, including 3.6 billion of customer advances, recognized revenue 4.6 billion, ending 1.8 billion. Now Microsoft. Microsoft reports under US GAAP. Here we talk large numbers. As of June 2025, accounts payable were $28 billion, other current liabilities 25 billion, and, what is of the most interest to us, unearned revenue 64.6 billion. Also, Microsoft had 2.7 billion of long-term deferred revenue, 67.3 billion in total. All elements significantly increased as compared to June 2024. On page 61, in note 12, we see further information on deferred revenue. Firstly, there is a split by segment. The largest part relates to productivity and business processes, 50.6 billion. And this one was the key driver of the growth. It increased by 7 billion as compared to the last year. And similar to NVIDIA, there is a roll forward here, from which we see that the additions to deferred revenue were 187 billion and exceeded recognized revenue 180 billion. This may show that in the next year Microsoft potentially will have higher recognized revenue based on higher deferrals. Other current liabilities of Microsoft mainly included operating leases of 5.4 billion, finance leases of 3.2 billion and declared dividends of 6.2 billion. In general, when looking at the numbers, here is a short reading checklist, how to scan the 4 liability lines quickly. Trade payables. Compare to cost of sales and inventory turnover. If payables are shrinking while inventory grows, that may cause pressure on cash. Other liabilities. Look at what's inside. Payroll, marketing accruals, taxes, leases. The increase here may be related to timing or growth of the business. And check notes for details, like PepsiCo's marketing accruals. Provisions. Check the roll forward and what risks they cover. Also scan for contingent liabilities for exposures that are not booked yet, like Unilever's Brazilian tax matters. Deferred income or contract liabilities. Look for additions versus revenue recognized, and how much sits in current versus non-current. NVIDIA's and Microsoft's tables are a perfect model. Now let's have a look at how liabilities are reflected in the cash flow. We will look at Microsoft as it had the largest deferred revenue balances. In fiscal year 2025, we see a positive impact from the change in trade payables, 0.6 billion. 5.4 billion were contributed by the increase in deferred income and 5.9 by the increase in other current liabilities. And if the increase in accounts payable and other liabilities means that less payments were made to suppliers as compared to the last period end, the increase in deferred income means that more cash was collected from customers, a very much direct cash-in from operations. That's why the market likes subscription models and growth in deferred income. Let's have a quick look at real-life days payables outstanding. We will check Unilever and Microsoft. DPOs are typically calculated as trade payables divided by cost of sales times 365. And let's ignore VAT topic here. What do we have for Unilever? With trade payables of 10.3 billion and cost of sales of 33.4 billion in 2024, DPOs will be 10.3 divided by 33.4 times 365 equals 112 days. So it takes on average almost 3 months to pay suppliers. How does it compare with 2023? Here is a small comparison table. The DPOs were almost the same at 110 days. So no big movements at this point. And here also with the formulas in Excel, so it is easier for you to follow. What about Microsoft? Here we have the following situation. As we don't have a split of accounts payable into trade and other payables, let's take the full amount. As of June 2025, DPOs were 115 and increased as compared to June 2024 with 108 days. So it looks like Microsoft pays slower and improves cash flow with that. But here is a thing. If we scan the annual report, we will see on page 54 that purchases of property and equipment remaining in accounts payable were 6.9 billion in June 2025 and 4.3 billion in June 2024, and these ones are not operational. Again, we don't know how much depreciation sits in cost of sales. This information is not disclosed. But let's, as a matter of interest, remove capex payables from accounts payable. The impact is material. Now, DPOs are the same in both periods at 87 days, so the increase in original number may be related to increase in investments. So, you see, always check for the notes and disclosures and don't jump to conclusions. They may contain crucial information for analysis. Having looked at huge corporates, how do these liability lines hit our Apple shop as a comparison? Buy more apples on a 30-day term, trade payables will go up. Month-end payroll and taxes accrued, other liabilities go up. A customer prepays for a 3 months fruit box, deferred income goes up now, revenue recognized 1/3 each month. A likely refund on a quality issue, provision is recorded. Let's summarize the lesson. Trade payables tell you how the company funds its operations day to day with supplier credit. Other liabilities bundle lots of short-term obligations. Always read the notes. PepsiCo's breakdown is a great example. Provisions reflect judgment. Cross-read contingencies to understand unbooked risks. A great example, Unilever's Brazilian tax disclosures. Deferred income bridges cash collected and revenue recognized. NVIDIA's and Microsoft's roll forwards are the models to learn from. And that's your crash course in trade payables, other liabilities, provisions and deferred income with real numbers from Unilever, PepsiCo, NVIDIA and Microsoft. If you have other questions to liabilities in annual reports, post them in the comments below. Thank you for watching. If you enjoyed this lesson, hit like, subscribe and ring the bell so that you don't miss the next lesson. See you soon and keep those debits equal to your credits.